All right, awesome, guys. Again, this is the Money Mantra. We are back with another free Forex trading training to help you step your game up when it comes to day trading Forex or whatever it is that you choose to trade. Me, I like to focus on understanding the charts, so understand what's going on in the market, market structure, support and resistance, and finding simple strategies to find those entries. You can really day trade as long as you understand a few simple things. Most of it is mainly psychology and is what's happening in your head at the time that you're trading. Do you have the resilience? Do you have the confidence? Do you have the patience to actually become a profitable trader? And if you say yes, that's amazing. You just maybe have to work on your strategy. And if you say no, then you're probably going to want to take notes and know that those are things that you need to work on in order to be successful. You need to be diligent. You need to be patient. You need to really be focused and serious about making this a serious stream of income because it can really change your life. Now, my name is Cha Cha. I am the host of the Money Mantra. Again, I teach simple Forex strategies and also general mindset, which you can find on my channel if you go to the Off the Charts playlist or any of the trading playlists that I have there as well. So that is on YouTube. Make sure you like, share, comment, and subscribe if you have not done so already. And if you do feel like you need a private session, you can send me a message and we can discuss that. Now today is going to be an in-depth intro to Forex trading. So going over some of the basics that every retail trader, which is people like me and you, need to understand if we want to be successful in this market. So first and foremost, we need to understand what is Forex, who trades it, and why is that important. So Forex is short for the foreign exchange market. You may see it online or stylized as Forex or FX. And it's a global marketplace where we exchange national currencies. Now, if you've ever been out of the country for any reason, you may know that the US dollar, yes, you can spend it in other places, but every country essentially has their own currency, right? Or some countries may have a similar currency, but it's different everywhere we go. Now, if I were to go to Canada and let's just say I had $100 and I had to exchange my money, I may get back 170 Canadian US dollars. That just means that forever, for let's just say I get back 101 to make it easier, Canadian dollars. That means for every one US dollar I have, I'm essentially going to get $1.01 for the Canadian currency, or something along those lines. I hope I didn't confuse you guys. So Forex traders, what we do essentially is we do this digitally. We monitor price action, we may check the news, and we just follow along to see which currencies are going to go up and which currencies are going to go down. Now, a common misconception is that you may have to spend all day on the charts, or it takes a really long time to actually get into a trade, but that's not true. You can actually do your analysis in a matter of minutes and you can really see that profit jump, which is something we're going to go over today. What exactly are you looking at when you get into the market? And how are people finding these entries? So, another fact about Forex is that Forex markets tend to be the largest and most liquid asset markets in the world. This just means that there's so much money moving through this market. I believe it's a little over $6 trillion a day. And it also means that you can withdraw from this market easily. I know there are a lot of things going on online about Forex, but it's actually not a scam. You can Google Forex news, or you can just Google Forex and you'll see how much information pops up and who are actually the people that are trading in these markets. So the main players, and it's really important to understand this, who are trading in the foreign exchange market are financial institutions like commercial banks, central banks, money managers, hedge funds, and retail traders, which are pretty much everyday people who are deciding to say, okay, I'm going to think like the banks think. How are the banks making money? And the banks are making money based off of doing analysis on society. What is the climate of society? Are things going really well in the US, meaning that the United States dollar will increase in value? Or are things going really bad in the United States, which meaning that the dollar may sell? So they're using these basic, simple information and questions to determine if they're going to buy or sell, and they're doing it in large amounts. Now, here are some facts I just like to highlight about Forex because it's very important that you understand this. I know a lot of people may work. You may have a job that you love. You may have a job that you don't like at all. and you feel like you don't have time for something new in your life, you may think that you don't have time to do this, but the Forex market is actually, and this is something you can write down if you're taking notes, the Forex market is open 24 hours a day, essentially 5 days a week. So the bigger time frame would be Sundays from 5 p.m., right, all the way till Friday at 5 p.m. So if you have any time within those hours from any Sunday at 5 p.m. to the following Friday at 5 p.m., then you have time to trade. And that's just the affirmation that I need you to write down for yourself, because people will talk themselves out of this saying, okay, I don't have time to do that. Now, what time you do trade is going to be completely up to you. There are four major markets. And you can see I have this here, so you can screenshot it. Just letting you know that these are the most active sessions. You can trade anytime during the day, but these are the most active sessions. So I'm just gonna go from right to left because we live in the United States. The market that a lot of people trade is the New York market. It's open from 8 a.m. to 5 p.m. And the reason is because that's what time the banks are open. So you are going to see a lot more faster action happening during this time, depending on the currency pair that you do choose to trade. Now, the London market, for the people who may be night owls like myself, I'm typically up around 3 o'clock in the morning, and that's when I will take my trades. It's open from 3 a.m. to 12 p.m. So if you're up overnight, you're just in bed, and you want to hop on the chart to look at the market, you do have the option to do that during those hours as well. Now, the Tokyo market is another market. It's open from 7 p.m. to 4 a.m. So that's another good session for people who may work during the day, take a little bit of time to unwind, maybe take a nap. And then you have up until 4 a.m. to get into that session if you're trading those currency pairs. The Sydney market or the Australian market is open from 5 p.m. to 2 a.m. Again, this could be perfect for people who have a 9 to 5 job. Maybe you have children and you have to get them settled after school, do their homework. Again, you can trade within this market. Now, to the right of this, I just have another fact about Forex is that these are actually all of the currency pairs that you can trade. Like, well, there's more than this, but these are some major currency pairs that you can trade. So not only do you have all these options of assets that you can make money from, you also have all of these times to essentially hop in the market and make money. I do want to give you guys a tip. Since this is a beginner's course, I think that it's very important if you choose a time to trade consistently every single day. So if you know you want to wake up early and trade, do it at the same time every day. If you know you want to trade late at night, do it at the same time every day, because sometimes you can be doing everything right, but you're not finding that consistency because you're jumping all over trying to make money. If that's ever happened to you, you don't have a consistent trading schedule, but you trade at random times and you feel like you're losing more money, just drop some sevens in the chat. Now, the most important thing when it comes to Forex is understanding how do you make money, right? And it's very simple, but I will go over this a few times just because, again, this information may be new to some people. Again, I do encourage you guys to take notes or to make sure that you are subscribed to the YouTube so you will know when I actually post this video. So the market basically has candles. These things are called candlesticks. If you look at any chart, this is what you'll see. The red candles means that price is going down currently, and the green candles or blue candles, depending on which platform you're using, usually tells you that the market is going up. So it's pretty simple. You'll see these shapes on every single chart. And sometimes, because these are called candles, these lines that come from the candles are called wicks. And the wicks will tell you the highest place that price was. This will tell you where price ended. This will tell you where price opened, and this will tell you the lowest place that price was. So just to keep it simple, let's just say the market opened right here and the price was $1. But then the market closed right here, let's just say, and the price was $2, right? So the opening price was $1, the closing price was $2. The high may have been $2.20, and the low may have been 90 cents, right? So these wicks are just giving you more insight into, okay, where does price have the potential to go? And that's something that's important that you want to know when you start trading Forex, because all as a trader, all you really care about is price action. Is price going up or down? And am I getting in for this buy and for this sell? And it's the same thing with a green candle. You'll see that price has opened down here. I think this is reversed because this should be down and this should be up. But you'll see that price for a buy typically opens here and it closes here. Yeah, this is reversed because the sell should open up here. And that just means price is consistently going up. Now, another important definition to understand, and we are going to get into the charts, guys, just to bring all this information together. But another important thing to understand, and where I've noticed that a lot of people are messing up on their trades or getting profit, is when it comes to counting pips. Now, pips are simple. It's just the measurement of that the market, the unit of measurement that the market is measured in. So, for example, if it was 75 degrees outside, we know that temperature is measured by degrees. It's 75 degrees. We wouldn't say, "Oh my God, it's so hot. It's 75 miles per hour out here." We would not say that because miles per hour is what we use to measure speed. So, when it comes to the market, what we use to measure the market is or are pips, right? So you'll always see when you're looking at a chart, you'll see all of these numbers. And that's just pretty much telling you what the current price is, right? So if you see 1.24745, you just know that price is around $1.24 or $1.25 for that currency pair. But when you're trading, you always want to remember, especially if you're doing Forex, because this is not a binary options class. When you're trading Forex, always remember to disregard the last digit. So we're going to, sorry, I'm just looking for my little pencil. So we're going to disregard the last digit, and we're not going to pay attention to any of these fives. So if the market was to go up 1 pip or 1 point from, remember, we're only paying attention to these two, only these two. If the market was to go up 1 pip from this 7.3, it would now be at 7.4, right? If the market was to go up 10 pips from 1.2473, then the new price would be 1.2483, right? Because we're disregarding that last digit. It's called a pipette, and we do not need it when we're calculating our price movement. 100 pip movement will be from 473, 1.2473 to 1.2573, right? In that case, we went up 100 pips. If that makes sense, guys, just drop some sevens in the chat, because understanding pips and what we're going to talk about on the next slide, which is lot size, is really going to determine how much profit you are able to make when you decide to get into your trades, right? This is all going to be determined on you. A lot of people like to ask, okay, how much money should I start with? How many pips should I go for? That's completely up to you, depending on your account size. How much are you willing to risk, right? And I'm going to show you some really great examples of this, right? So you're going to calculate your pips and where the market is going based on whatever the trend is. And this will be super easy to spot, even for somebody who's never traded Forex a day in their life, or you've never seen a chart. If I simply tell you that green candles mean buy, and if you see more green candles than red candles, then that's an uptrend. Prices continuously going up, and we can even see it demonstrated clearly here in this photo, right? Price was here. We see more green candles than red candles in this section. So we can agree that this is an uptrend. Now, the opposite would be if you're seeing more red candles, right? That's just going to mean that the market is in a downtrend. Price may have started up here, right? And then price decided to get lower and lower and lower based on the amount of sellers that were in the market, right? And I'm only telling you this because these are things that you can easily identify with your eyes, even if you've never traded Forex a day in your life. Uptrend, more green candles or buying candles. Downtrend, more red candles and selling action. And a sideways trend, which will sometimes be called consolidation or ranging market, is just moving sideways. Like I wouldn't be able to look at this and see if it's actually going up or if it's going down because it's actually doing both. Now, overall, the market is typically going to be doing both. It does some big jumps, it does some small jumps, but that's where you determining your profit is actually going to come in at, right? Now, people always want to know, okay, how do I make money in Forex, right? And it's just a matter of understanding what you're looking at and understanding your risk, right? So when it comes to trading, there's a few different things. There's a few different ways that you can get into the market, a few different lot sizes that you can use. So we're going to ignore this column right here, the units, don't just disregard that. And we're going to pay attention to standard, mini, and micro. We're only going to pay attention to the top three. Now, once you download your trading app, whichever app you're going to be using, you're going to notice that you can get into a trade for the smallest one will be 0.01, right? And you'll notice on my story when I post that sometimes you'll see that next to the currency pair. And all this means is that I've risked 10 cents per pip, right? So I've risked 10 cents per move that I think the market is going to make based on if it's trending. Is it going up? Do I think it's going to go up 10 points? Do I see more red candles? Do I think it's going to go down 10 points? Now, if I was only risking 10 cents, which is amazing because another misconception about Forex is people think you have to have a ton of money. But when I tell you guys, I literally turned like $2.10 into $70 in one day just this weekend. I was just like, I love it here, right? So let's just say, I'm going to just use simple numbers just to keep it easy. Let's just say we were going to get into a trade with a 10-cent lot size and we were going to try to multiply our money. Let's just say we think that the market is on it. We see that the market is on an uptrend. So we want to get into a trade for only 10 pips. So let's just say the market is currently at 100. We believe that the market is at least going to go to 110. So if we're risking 10 cents per pip and the market actually hits 110, somebody put in the chat how much money will we have made from those 10 pips. So we're doing 10 cents per pip and we're only getting 10 pips. I know somebody knows the answer. Right. You would have made $1. You would have only made $1. Now, for some people, that's nothing. But if you dropped a dime on the ground and then you picked it up and it turned to $1, that is absolutely amazing. And that is still some good profits. But let's get into the next lot size that you can actually use, right? Which is 0.10. And that's $1 per pip. So let's just say we take the same trade example. The market is currently at 100. We see that the market is trending up. We think it's going to go up about 10 pips and we're risking $1 per pip. And that same exact trade where somebody may have only made $1, the next person really just made $10 in that same trade, right? And then a really great lot size to use once you have the capital to do so is the standard lot. And that's $10 per pip, right? So if I'm risking $10 per pip, and let's just say my daily goal is $100 a day, I would only need the market to move up or down 10 pips in order for me to make that profit, right? I would really need the market to move up or down 10 pips. I mean, up for me to make that profit on a buy and down for me to make that profit on a sell. Now, you don't always have to use ones. If you wanted to use a 50-cent lot size, it will be 0.05, right? If you wanted to use a 70% lot size, it will be 0.07, right? So you can play with it a little bit, but this is the lowest that you can get into. And then 1.0 is the lowest standard. Now, I really want to show you that this is important because you have to know how to calculate your pips so you can know how much you're actually willing to make and how much you're willing to lose, right? So in this example I have here, we have, let's count the wins. We have 1, 2 wins, and we have 3 losses. But let me tell you how we're still going to end the week in profit, using our stop loss, using our take profit, and using our pip strategy, right? So let's just say you start your account with $100. You're risking $1 per pip. You have a 15 pip stop loss and you have a 30 pip take profit, right? This is called a 1-to-2 risk to reward ratio because you're only risking 15 pips. But if the market goes in your favor, you're getting double the profit, which is amazing, right? Now, a stop loss is, let's just say I get into the market at 1. Let's just say I get into the market at 100. And the market decides that instead of going up the 15 pips that I thought I was going to get, it actually goes down. So which means I'm losing money. But you want to have a stop loss because you want to say, okay, this is my limit of loss. This is how much money I'm actually willing to lose for the day. If you're only willing to lose $15, you can risk $1 per pip. Or you can even risk 50 cent, and then you will have 30 pips or something like that you can actually risk. Now, if the market hit our stop loss, instead of our account being in profit, we would now be down $15 because the market went the other way. But if we doubled our risk, right, and had a short, doubled our reward and had a short risk, if the market went in our favor for 30 pips and it went up 30 points, we would make $130, right? That's amazing. We short, quick market movement. And I'm going to show you guys the chart and how quick and easy this money can actually be made. Now, let's just say our next trade, now we have $130 because the market hit our take profit point. We knew it was going to go up and then it went up. And let's just say we want to risk $1 per pip again. And we're going to do the same thing. We're going to have a 15 pip stop loss, which means that if the market goes backwards, we're going to lose $15 because that's how much we're willing to lose. And if the market goes up 30 points, we will be at 160. Now, you're not going to win every trade. So just for this example, let's just say we lost that trade. Now we're at $115. But do you see, because we had a 1-to-2 risk to reward ratio, we still have more money than we started with, even though we won one trade and we lost one trade, right? If that makes sense, guys, just drop some sevens in the chat, right? Now we're going to go to the fourth trade. Let's just say we won our last trade for 30 pips, $1 per pip. And now we have $145. We're going to do the same thing because you want to have consistency in trading. We're going to be risking $1 per pip. Let's just say we have a 15 pip stop loss. So if the market goes backwards, we lose $15 and we will be at 130. If the market goes up, we would now be at 175. But even if we lost this trade too, and we lost the last trade, we would still be ending $30 more in profit than what we started during the week, just because of our risk to reward ratio. Now, if I gave you $100, you don't want to go and put that whole $100 into the trade. That's not a proper risk to reward. The purpose of this is to multiply your money. It's not to lose money and give it back to the market, right? Now, again, this is how you calculate your TP and your stop loss, whatever your entry is, let's just say, and I'll draw it out for you guys just so that it makes more sense. And again, I am going to go to the live charts, but this is all fundamental knowledge that even a beginner should be able to understand about Forex trading. So let's just say your entry was 100 and you believe that the market was going to go down 10 points, right? So your target is 90, right? You only need the market to drop 10 points. Your target is going to be below your entry because it's for a sell. It means price is going down. And your stop loss would be 110, right? Because we're expecting the market to go down. But I'll be the first to say that the market does not always do what you want it to do. Sometimes it will go the other way. That's why you have to set your parameters, right? You have to set your take profit, which is your target, and you have to set your stop loss so you can know, okay, this is the maximum amount of money I'll lose, which will be $10, and this is the maximum amount of money I'll make if the market goes in that direction. Same thing here. If you're looking for a buy opportunity or position, if your entry was at 100, this time your target will be 110, right? And your target could be any number above 100 that you want it to be, right? Any number above 100, because we think price is going to go up. And if price goes down to 90, we know that we're going to have a stop loss right here. And the stop loss just means that you get taken out of the trade once you've lost however much you're willing to risk. In this case, it's $10. Once we hit 90, we would get out of the trade, and then our balance will be updated to whatever your new balance would be, right? So that's extremely important as well. Now, why does this matter, right? And here are some screenshots from 2 accounts that I have, and I just want to explain why those pips and numbers are important. Because I'm pretty sure if you guys follow me on Instagram, you see these screenshots that I post, but you may not fully understand, okay, what does this actually mean? So I'm going to break it down for you. So these trades are from today, right? These trades are from today. You can see that I got in for a Euro USD buy at 50 cents per pip, right? We can see that the market didn't really go up that much. It went from 3.4 to 3.8. So I made $2, right? I made $2 because remember, we're only focusing on these 2 numbers. From 3.4 to 3.8 is only 4 pips, guys. And 4 pips times 50 cents is how much? That's $2, right? So that's a small win, but small wins add up, which I'm going to show you in the next example. So in this trade here, we can see that I enter a sell for USD JPY, and I did the same thing, right? I like to keep my risk consistent. I'm only risking 50 cents per pip. We can see that the market dropped from, because this is the Japanese yen, we can see that it dropped from 144.05 to 143.74. And that must have been something like 20 pips or so, right? Because I made $10.61 in that trade. The next trade, I did the same thing, 50-cent risk. And you see that in this case, the market dropped. I went for a sell. We know because it's red. We can see this was my entry point, 0.9648, right? Remember those two numbers. I decided to get out of this trade at 0.9638, which is a 10 pip difference. 10 pips times 50 cents is going to be $5, which is why you see this profit here. Now for this trade, I'm going to skip over this one because I think you guys get the point. In this trade, I knew that Euro USD was going to go for a buy. Here I was just testing the waters. I said, okay, it's at my support and resistance zone. So I got in here, right? As you can see, it's closer to my other entry point, 3.6. So I got in at 0.9636, right? And I only got in for about 9 pips. But this time I risked $10 per pip, right? Because I had the capital in my account to do that. And then look, the market went up about 9 pips and I made about almost $90 from that trade idea, right? So if that's making sense based on what we just went over in that live example, just drop some sevens in the chat. I just want to make sure that you guys are following, right? Because this may be a lot of information. But again, the more you hear it, the more you listen to it and you go back and watch it, you're going to really be happy that you did. So on this other side, so that was just one day. It was $115 in one day. Now for we're going to focus on this green section. This was $597.39 in 1 week. So with this, you can see I took some bigger risk. I got in for a USD JPY sell. And I got in for another USD JPY sell here. And then you can see I used a $10 lot size, right? Because 1.0 is $10 lot size. Now, previously you saw I used a $10 lot size and I made $86. Cool. But then here you see I used the $10 lot size and I made $253. Why? Because the market dropped down from 57 to 20, which is about 30 pips, and I did $10 per pip, right? So 10 times 30 is going to be around this number. And the same thing here. The market dropped from 1.4474 to 143.99. And I was able to make about $518 based off of a 50 pip movement, which is amazing, right? You'll also see that in this same trade, I lost $100. You'll see down here in GBP USD, I lost $200. You'll see I lost another $200. You'll see I lost another $200, $205, right? But then in between, you'll see these small wins. So even with these catastrophic losses, did I still end the week in profit, guys? Like even with the big losses, right? Even with losing, for one, you see more blue than red, which is amazing. But you'll also see that I still ended the week in profit, right? So one thing you need to understand is how to calculate your loss and your risk, because you can take very small trades for 50 cents and you can see how that money can turn into $2.10, $10.61, $5, or you can increase your capital and you can see how your 10 pips could either take you to $86 or your 10 pips could take you to 600 and beyond, right? So we're going to move on, but I did want to show you guys that how everything I just talked about, based on the buy, based on the sell, based on your entry point, based on your risk, you always want to make sure that even with those losses, you're coming out with more money. Now, I'm not going to spend too much time on these slides just because it's too many little words and I really just cannot. But you guys can take a screenshot because this is pretty much an overview of the trading platform that I use. It's called MetaTrader 4. And this just pretty much explains to you in depth how to use these features, right? Because it's one thing to, okay, I have this information, but the next thing is, how do I actually get into a trade? How do I start trading? Now I know recently MetaTrader 4 was allegedly removed from the App Store. So you may have to find another broker. It still should be available for Galaxy phones, but um, just take a screenshot of this so that you can have it for future reference. It lets you know how much you're in profit. It lets you know what your balance is. It lets you know where you can find the currency pairs and essentially just how to use the app. And then here are two more screenshots that this is another screenshot that you can also take of two more things that's going to really help you understand your MetaTrader 4 once you decide to start trading. So once you screenshot this, please just drop a 3 in the chat so that I can move on to the next slide. And we can get into some trade examples. Okay. I'll give you guys about 15 more seconds. Then we're going to get into the fun stuff. All of this for me is the fun stuff, honestly. All right. All right. So I'm going to assume everybody has their screenshot. Um, and now we're going to get into the actual chart, how you guys can really get into this.